Hello, YouTube. Are the Bears silly enough to fall for the trap again? What I'm talking about is exactly 2 years ago in November of 2020. We got a bullish pattern, which was a close over the previous candle high. We're seeing that exact same pattern happen right here, right now. And this is happening at a time when there might be some bear fuel or the trap. Why? Moody's. Everyone thinks the US actually got downgraded. The answer is maybe it's a little bit different. But as we're talking about a government shutdown, the timing of Moody's is no surprise. What they're basically saying is get your house in order, right? Get your house in order. Otherwise, if you shut down, we're likely going to downgrade you. What I want you to really keep in mind in terms of the trap, I'm going to provide evidence. So please make sure you watch until the end. But the seasonality chart provides a very good template for us. We went through this on the stream I just finished. But after one cut, two cut, dead cat bounce, third cut, we usually go higher. But there's a period of indigestion after we hit the key relative high before we ultimately advance. I'll walk you through this really fast right now because I think it's really important for us to follow along. But just look at the pattern. If we hold around here up until the end of the month over 439, man, people are going to really regret being short in this market. Why? Look back to what happened since 2020. We're pointing up. And when we hit support, it usually means it's a buying opportunity or that bargain we just talked about. And after finishing a 10.8% decline, it's been a straight line higher. In 2 weeks, we've almost recouped the whole move. Now let's look at the seasonality chart and see if we can actually understand what it's showing us here. So again, one more time, I understand this is supposed to be for October. Just please bear with me. One cut, two cut, dead cat bounce, third cut to the lower low, low, lower, lowest. Let's look here on S&P now. And if we go here to SPX, let's just clean up the chart. Let's hide everything. What do we have? Why? Because this is really, really, really simple. Let's go here. We get our first, and let's go to a line chart to make sure it actually looks very similar. The line chart only cares about the closing price. One cut, two cut, dead cat bounce, third cut to the lower low. One more time. One cut, two cut, dead cat bounce, form the lower low, lower, lower, lowest. And then eventually we get back up towards that relative high, and we closed above it just now. So let's see what happened. Okay, so we got our one cut, dead cat bounce, two cut. There's our bigger dead cat bounce. There's the third low. There's the reversal right back up to the relative high. And what did we do? We had a little bit of indigestion here. Then we closed higher. What usually happens next? Well, we usually get a big cut. And that's where, if the bears are not receptive to the government shutdown maybe being averted, remember, that's how McCarthy lost his job, though. This Moody's thing might really provide the fuel for us to have that drop down. But here's the important caveat. And again, please make sure you watch until the end of the video if you want all of the insight. But here it is in a nutshell. Moody's is going to create some fear. They released it on a Friday after the market closed on purpose. If we look here to the chart, what it implies is that we're looking for a higher low. So if we look here, we have low, higher low on a closing basis. Remember, on a closing basis. So if we move lower on Monday and we go below our relative low here at 43.47, just over the 50 MA, but we close above, that would be the higher low. That would be the trap, because normally, if we zoom out, November is the best month of the year. December is the second best month of the year. And we saw this exact same trap going back to 2020. So that is it in a nutshell. I'm going to go through and provide even more evidence, but last thing I'll point out here is we're using a hollow candle, which means it might be a little bit harder to read on the screen, but look right here. Close over the candle high, 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 close over the candle high. We keep doing that same pattern over and over. And no surprise, we go up. If we look here onto the weekly chart for the S&P, close over the candle high, close over the candle high. I hope you're getting it now. I don't love repeating myself, but man, this story is so simple. It is so uncomplicated, and there's so few people who actually want to be receptive to it. We're currently over the candle high. We had a big bearish engulfing daily candle on the daily, which means we did fall back below. But as of right now, we are currently above 438.14, which means if we can hold into the end of the month, I'm looking for a nice big move higher. And I have a target as well, which I shared in a previous video, and we'll get to that at the very end. The very last thing I want to do is I'm going to ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. Thank you ahead of time. The other thing I want to show you is that I was thinking of actually making a different title, but I'm going to show you something different here. So we're going to go to a very simple chart on a 1 week, and I want you to just think about whether or not this looks like it's a trap. And then we got a whole bunch more data to go through, so please make sure you stick around. Here we're looking at a chart that shows us S&P 500 stocks above the 50 DMA. And we're looking at a weekly chart. So what does this mean? Every time we get an extreme reading, what happens? Violent snapback, violent snapback, violent snapback, violent snapback. Every single time we get a violent snapback. Where do we have to fall below for this to be a good reading? It's usually about 15 to 20. So what does that mean? It means 1 in 10 stocks is above its short-term price and 90% are below. We hit below, rocket right back up higher. That is March. That's the SVB crisis. Over here, we have the low, which is September, October of 2022. And now more recently, we have that low we just established. But now we're picking up momentum and we're almost at about 50%, which means now the average S&P 500 stock is actually advancing. Not quite at 50%, which means there's still more upside opportunity. Here's another one. Here we're looking at above or below the 200 DMA. So above or below the 200 DMA. This one is a much higher time frame. So when we look here, we get an extreme reading at roughly 20. This time it's not quite low enough, but same thing. There we have 2022. That is the low. We go back here to 2020. That is the low. That's the lockdown low. Then we go to the Jerome Powell low. It's right there. Every previous time, it is a violent reversal. Dramatically up, dramatically up, dramatically up, dramatically up, starting to go dramatically up. I would not say it's one yet. So we're seeing a lot of indicators that tell us the same story. This we cannot ignore. This could be very bearish, but I think it might be a trap, as I just alluded to. I'm also going to tell you exactly where I'm going to be wrong at the end of the video when we go through more charts. So let's read this one more time and see if it makes sense to us now. 5 to 10% corrections are normal. We just had a 5% dip, and then we went down for a 10% one. Let me make this so simple that you cannot ignore it. All right. We have the levels right here. 436.50 is a 5% dip. 413.5 is a 10% dip. Where's the low of our first dip? Oh my goodness. 433, which is below 435. So we get a dip. Then we get a correction. So we got both, actually. We got both of them back to back. Dead cat bounce, form a lower high, which starts the channel. And then we go down for that corrective move, which forms all the way down here at 409, I believe. Yeah, 409. Okay, let's read this one more time here because this seems simple. 5 to 10% corrections are normal. Since 1946, 84 have happened between 5 and 10%. By the way, we just notched 2, and that works out to more than 1 per year. We just got 2 in a month. So we got the one for SVB, right? That's a nasty cut we got here. I think that was a correction too. From peak to trough, we went down by 9%. And as it noted, within a month, we usually are higher. The average time it takes to recover from those losses of 1 month. SVB, 1, 2, 3, 4 candles, we're basically right back up to the high. I hope you're following along. I hope the story is simple. And I hope that you are bearish. If you're bearish, you're starting to see that maybe this is at the start of more. Look at the channel. Look at QQQ. What did it do? It busted. It busted. If we look at Apple on a 12-month chart, what are we? Oh my goodness, 12-month and bullish annual candle over the previous high. Yes, bullish. We look at Microsoft, new all-time highs. Not just over the previous high, new all-time highs as of the closing price on Friday. Incredible. Which means if we look to XLK on a 1-month chart, what do we have? Oh my goodness. There's 50% waiting for the big Apple and for Microsoft, and we're through earnings for both. And we're back over the 2021 high. I just showed you Apple. I just showed you Microsoft, the 2 largest companies in the world. And as of right now, we're back over that previous high. And looks like we want to make a run for the all-time high we established here in July. Okay, so these moves are normal, but everyone keeps thinking this time's different. Deeper declines do happen, but they happen a lot less frequently. So until we get evidence we're going lower, let's be mindful this might be a trap. All right, let's tell the story. Moody sends a warning to America. Your last AAA credit rating is at risk. What does this mean? It means they've changed their outlook, right? They changed their outlook for the nation's debt. What they did was actually maintained. Moody's is the only one of the 3 major credit agencies to assign the U.S. an outstanding rating of a AAA, which it has maintained since 1917, which means it did not get downgraded. It downgraded the outlook on the risk that we could have that government shutdown. Other agencies downgraded in 2011 on a similar issue with the debt ceiling, and McCarthy just lost his job to make sure that we didn't get one. So thank you very much, McCarthy. I appreciate your service. looking here to the issue and what Moody's is pointing to is percent of GDP. And then we look here and see that the net interest, which is really quite low right now, is sitting here about, I don't know, like about 2% at the end of 2022. But it's going to start to exceed defense spending. It's going to start to exceed non-defense discretionary. And then it's going to exceed Medicare and then exceed Social Security. What does this mean? Jerome Powell's not the issue now. The issue was Joe Biden going burr and printing money, which means we're getting more and more inflation. We're getting more GDP, which is excellent going into a political cycle, but it's a double-edged sword. So this is the issue right now. And I want to point out to one more thing here because the headlines really tell us what they're focusing on. Political instability at the forefront of Moody's action. I understand what they're talking about. What another downgrade could mean for Americans. It's not good. It's not good at all. So let's keep that in mind. And I'll come to the story in a few minutes here. It's been a pretty good week for the bulls. Looking at the last 1 week, clearly big tech pulled ahead. Fear is still dominating the market, but we're slowly creeping higher. If we look here to our timeline, what's different this time is that just like in October, going back to 2021, we hit extreme fear and then we bounce back violently. Well, this time we bounce, get a lower high. So high, lower high, lower high, lower high, lower high. Shake out here in extreme fear 1, 2, 3, 4 times. And now we're trying to advance, but it's only flagging out. We need this, not want, need this to go into neutral for bullish. Otherwise, buying fear might just lead to a dead cat bounce where we go down. Is Jerome Powell saying, whoa, 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 time to stop? Well, Christine Lagarde and the other Fed officials let me see if I can pull this up. Christine Lagarde is talking about 4% being sufficiently restrictive enough to, here we go. So Jerome, maybe it's time to cool the jets, bro. ECB's Lagarde says keeping rates at 4% should tame prices. She's pretty confident at 4%. Jerome's over 5%, and he's like, actually, let's make sure we're not acting too preeminently. Like we're not going to act too prematurely. Man, stop it. The world's going into recession right now. And here's a quote from someone who's smarter than me, Mohammed Al-Arian, and he's telling us that blah, blah, blah. There's a large range of possibilities to go higher or lower. Pause the video if you want to read it. I'm focusing on the last part here. All this while, the acknowledgement that the main driver of the level of yields and their volatility in the recent past, the Fed, is likely to see its influence wane. Why is it likely to see its influence wane? Because the showdown in Washington right now is the bigger issue. Specifically, there is $7.6 trillion of government debt that will mature in the next year, adding pressure on rates. It's not Jerome anymore. That represents 31% of all outstanding debt. Remember, a small $24 billion auction is what actually caused all of that big bond volatility going into Thursday. So the Fed is not unimportant. It's just less important. And that's because we're starting to level off. It's called that Goldilocks period. And if we look here to just one more indicator to make it really simple, I've been calling this the 2007 period, where I think ultimately we're going to get a big hangover. There's a big recession here. That's the great period. But we go up and then we go sideways for a year and then we go into recession. Well, what are we doing right now? We've been going sideways. August of 2023. Okay, we're going sideways. Yep. August, September, October. It's now November. Oh, we're going sideways. We are going sideways. Okay. Now let's shift gears to what is actually going to drive the market this week before we look at the economic calendar, because there's going to be a lot on the docket for us to go through. CPI, PPI, initial jobless claims, PMI, lots of I's. And then we got that European CPI coming out, which we just showed you with Christine Lagarde. She thinks 4% is enough. The Eurozone is in a different debt situation than America. But man, what is Jerome doing? Is he going to squash the world? I'll give you a quick preview now on why I think Jerome needs to cool it a little bit. We're expecting a negative print here for Japan coming in preliminary for Q3, which means that could be the first quarter, which could start a recession. The UK just narrowly avoided that on Friday, where we were expecting a negative 0.1% print. They came in at 0.0. Canada is in the exact same boat, where they're barely getting any kind of growth. And what is Japan doing? They're talking about a poll suggests public is unimpressed by his stimulus package, but they're going to print $88 billion more. Why? Because they're seeing the future and there's a recession coming. And Jerome Powell is so focused on the fog, he's not noticing the wheels are coming off the bus. So we're going to talk about that a little bit later. if you're trying to land a plane, if there's no wheels when you land, it's like a bigger problem than not having a pilot. Actually, no. Autopilot's good, but not for landing. Anyways, moving forward. There's a big meeting happening this week. So the economic calendar does not reflect that. But on the 15th, we're also going to have the two biggest economies leaders meet. That's going to be Biden and Xi meeting where? In California. President Xi is going to be coming to California to meet Biden. Remember, not that long ago, he's been launching a charm offensive to repair China's tattered image. Their GDP stinks. People don't trust them, right? Their trustworthiness, lovable, and respectable. I don't think those are the words that I think of when I think of China. This is going back to April of 2023. They've been reluctant to meet. There's currently a lot of political tension around the world, to say the least. The bromance between this guy and the other bald dude from the country that starts with R. Yep, that's looking like it's not as important because China is currently struggling. The charm offensive is not working. So now he needs to go to right to the Dragon's Den. He has to go all the way to Washington. Sorry, all the way to the U.S. He's going to be in California. And this will be interesting for both of them because the stakes are pretty high going into an election year, as we just noted, which is important, especially for the downgrade. For both the Canadian Prime Minister, Trudeau, and Biden, polls suggest an uphill political path. The economy, and particularly inflation, has soured voters on both leaders, polls indicate, though well in advance of upcoming votes. So why does this matter? Because Biden is just losing in the polls for the New York Times versus Trump. That kind of really matters. If you remember, there's currently a couple of issues of contention between China and the U.S. One of them was the balloon incident. That was at the beginning of the year. Do you remember? Here's another issue. China's $10 trillion hidden debt mounting could be a ticking time bomb that Joe Biden warned about. This goes back to August. So let me see if I can find one more here. Another one from China. There's going to be a lot to talk about. And this is just what I found. It's not what is officially in what they're going to talk about. After adjusting for Belgium, China is estimated to have sold almost $40 billion in treasuries over the last 18 months. This is as of October 3rd. And they're also selling stonks. So like they're liquidating. And I'm not sure, again, put your tinfoil hat on if you think this is a coincidence. The world's biggest bank, ICBC, which is the Industrial and Commercial Bank of China, they were trading off a USB stick because they got hacked. And this was as it relates to the bond market and treasuries. So I think they're going to want to talk about that. And Joe Biden is pretty diplomatic. So what he did is send out one of his top lieutenants, Janet Yellen, to go talk to the Chinese counterpart to see and to feel about how they're going to be received. Yellen to intensify communication with China's he or her. Warns on Russia support. Okay. Let's close this one out. Yellen says U.S. wants healthy economic ties with China. The Treasury Secretary said she had pressed her Chinese counterpart on China's export controls and cautioned against supporting Russia. There you go, right? Nice little handshake there. Nice. So watching for that. And now, as we shift gears towards, and that's going to be, again, on the 15th. Now, as it relates to earnings, as I mentioned, earnings season is pretty much done. But I think we're going to get a pretty good pulse on the retail sector because we're going to have Home Depot, we're going to have Walmart, we're going to have Target or Target, depending on where you live. We're also going to get Alibaba, and we're going to get JD. We're expecting mixed results. I believe Home Depot's a beat, Target's a miss, Walmart beat, JD miss, Baba beat. So it's going to be mixed. But since most companies have now reported, the large caps, I don't think it matters as much. Part of the issue with Moody's, too, is that the U.S. has been spending a lot, which means that the GDP is artificially high. This Q3 print at 5.4 could be as much as 50% by government support, which means it would be at about 2. And now for this current quarter at 2%, I'm not sure what it would actually be. But again, looking to the rest of the world, the UK, which is part of the G7. Again, G7 means group of 7. That's going to be France, Germany, Japan, the US, Canada, and one more I forget right now. The UK. So UK basically going into recession. That's 1. Then we got Canada. That's 2. If not already in recession, pretty close on the brink. And then Japan's going to be 3. So 3 divided by 7 are not pretty good odds. And I've not even looked at everyone else. So is this going to last all the way into this time next year, which is when we have the election for 2024? I'm not sure. I think it's going to be very interesting. I forgot to mention too, and I'll do it at the end of the video, that if you want to see all of the prep going into today's video, you can watch that here under weekend analysis. I did a special stream this weekend just for you. Hopefully you appreciate that. And I'm going to ask you one more time to please consider smashing the thumbs up and subscribing to the channel if you're enjoying the content. Thank you so much ahead of time. I appreciate your support. All right, so I went through and did all the stuff on the other stream. So I think this is going to be mixed because core CPI is going to come in line. This is probably going to come in line. We don't have the number yet. CPI in a month over month coming down to 0.1, and then potential recession starting in Japan. Then we look forward to Wednesday when we got that meeting with Xi and with Biden. That's going to be extremely important. On the 18th, we have the potential government shutdown. That'll be on Saturday. And then after that, we've got CPI. Sorry, 1 second here. So we got core retail sales, which Jerome Powell actually pointed to as something important as a leading indicator. And we went from 0.7 and we're expecting negative 0.1. A contraction would be very well received, which means less demand, which means less price hikes, which means less inflation. PPI coming down to 0.1 would be well received as well because producers produce, then consumers consume. This is a leading indicator, which means it's costing less to produce stuff. Then as we move forward, PMI or the Philadelphia Manufacturing Index is going more negative. Same thing as PPI. Producers are contracting. They're not selling as much. Easiest way to try to explain it. And then we look forward here to the CPI coming out of Europe, and it's at 2 point something. 2 point something. The US wishes they were there. They're currently at 3.7. So if Europe's going to go down lower first, and then the US is going to follow, well, the US is probably way too restrictive right now. That's what I think Christine Lagarde's trying to toe the line with. They also have a lot more debt. Let's not ignore that. But now let's go through a couple more quick charts, because if we're going to see feedback from the bulls, meaning that we're going to trap these bears, there is a key area we want to focus on. And I'm going to make it so simple. So please just bear with me for about a couple more minutes. As long as we are over 438.14, it is bullish. If we fall back below, notably on a daily candle close, that is where it gets a little bit less bullish and more tricky. I'll show you the reason why here. And the reason why I've been flip-flopping a little bit, as you guys tell me I do all the time. Anyways, that's our previous monthly high, or the red line. What happened on Thursday? We gap up over the area, exhaustion gap, and we form a bearish engulfing daily candle closing below the low. But as the seasonality suggests, we just got that cut. So when we are below and we have an exhaustion gap with a daily bearish engulfing candle, if we would have gotten one more follow through day, boom, knock it down. That's where the selling can really start. All the way down to where? All the way down to potentially 409, 410, or to go back down for a monthly lower high. That's the risk reward. It's not great. So if we're over 408, the chance for a squeeze continues. And if we can't hold 408 for the rest of the month, well, how are we going to go higher? This implies a much larger move. So if we can't hold 440 or go higher to 450, this is not going to work. We're only going to know until the end of the month. But as we look here to our weekly chart shows that we actually broke the spell of being stuck in this channel where we hit the bottom or hit the top and we always reject. The market's not seeing broad participation. It's mostly tech, but we can't ignore that. Anyways, over the candle high, and over the channel. That's really bullish. And it's the NASDAQ which is actually dragging us up. Big pivot. So let's look here closely. This will be the last chart we look at. Why? Because we're going to review the rest of the stuff this week. So please make sure you subscribe. So look here. We close right on the downtrend, and then we pivot higher instantly. 2.9% week. Incredible. Why? Because we're up by 42% so far this year. That is truly incredible. But it's the pivot which I'm focused on here. The pivot off the line to go higher. Now let's look and see what SPY did. SPY is arguably, as we open up, we're going to be right around that area. 437. That's our monthly high, as we just talked about, 438. We could be looking for a move higher instantly. Or if we get a dip down on the Moody's and on CPI potentially, and then we rip up, I think that's going to trap the bears. I think they're going to really regret it. So anyways, I'm going to show you the bear scenario now from 2 weeks ago, where I walked through exactly what would cause me to get bearish. And if you want to subscribe, that should now be here on the right. Thank you so much for tuning in. I will see you on the next video. Thank you.